All right, today's market slide is an indication that we may be in the midst of a crisis of confidence. That is a takeaway from Bloomberg LP economist Joe Brusuelas, and he joins me now here to help us make sense of it all. And Joe, it's always good to have you here on Fast Forward, particularly in times of crisis, as you point out. The tough part, I think, for anyone watching this on a daily basis, and we have watched this pretty much for the last 2 weeks, every day, is where is it starting and where is it ending at this point? Is it Europe? Is that where all the troubles are in terms of our confidence, or is it in Washington, D.C.?
Well, I think that it's twofold. First is it does seem that the most intense portions of the crisis do tend to start in Europe. We had a very interesting European Central Bank meeting where they hiked rates, which the market didn't like. And then we had that very tone-deaf European summit from Monsieur Sarkozy and Ms. Merkel, which I think is what caused today's sell-off, right? And what markets are expressing a complete lack of confidence that elected leaders are up to solving the task. You know, I think this is going to stop when the Europeans want this to stop. Right now, the Europeans, I think, are having that Hamlet moment. It's to be or not to be. Are we a European Economic Confederation, or are we a European Economic Union? They like the fiscal independence that goes along with the Confederation, but they want the benefits conferred upon Europe due to the monetary union. Well, in order to have a monetary union, you have to have two things: a labor mobility and a fiscal union. And they really have neither. So they have to make that decision what sort of Europe they want to be, and the market's going to demand answers. Now, here in the United States, it's partially a crisis of confidence in the sustainability of the recovery. If you looked at the Bloomberg Consumer Comfort Index, if you looked at the Philadelphia Fed's Purchasing Managers Index, they were signaling to policymakers in the markets, we've lost confidence in the sustainability of this recovery. And it does look like, unless there's a policy shift or some further policy support coming, either we'll slide into recession here in the second half of the year, or in the first quarter of 2012, when there's expected to be a 1 to 1.5% fiscal drag, that is from the end of government spending and the start of austerity, we'll slip into recession there. You just choose when you want to go. Let
me ask you about Europe, Euro bonds, right? There was some speculation that that's what people wanted to hear coming out of that meeting between Sarkozy and Merkel. They didn't get it. But even if they had, what would a Eurobond do now to fix things? Is it about really kicking out some countries from the Eurozone, from the EU?
It would have done one big thing. It would have signaled that the European leaders recognize the gravity of the problem and that they're taking steps to preserve their monetary union. What I think it would have done is it would have stopped the panic. And that's what we're having, is we're having a classic market panic right now. What it would not have done was addressed the solvency issues of Greece, of Italy, of Portugal, and perhaps, Spain. That will take further steps on the part of those governments to shore up their own financial system.
All right, Jim, we are going to end it there, but I have to say, I do think that while it's nice to have a vote of confidence or something coming from officials of any country that calms the markets, I think, are getting to the point where they're looking past that and saying you're not fixing the real problem any longer.
That's right.